Staff Works Explained. If you are here for the first time, please consider subscribing to this channel. You can watch different videos that you have made on this channel. You can leave your comment, like, share, and don't forget to subscribe. In this video, we'll be talking about the insurance challenges that East African crude oil Eacop project is facing. There are reports that several insurance companies have opted out of insuring the East African crude oil pipeline, that is Eacop. This adds to the project's woes that have delayed construction for 4 years. Eacop is the 1,443 kilometers pipeline, which is starting from Hoima in western Uganda all the way to Tanzania Indian Ocean port of Tanga. The pipeline is owned by majority company, which is Total Energy, which owns 62%. The state oil companies of China, Uganda, and Tanzania, which have varying stakes in this project. Eacop is planned to pass through areas which some regard as or are regarded as sensitive, including national parks, wildlife reserves, and there has been criticism from international environmentalists that this poses a challenge. But the government has allayed fears, stating that all safety measures have been taken. A total of 28 insurance companies have so far declared that they will not insure Eacop. This is due to pressure from climate activists who argue that the project poses significant pollution and human rights risks. Last week, Sirius Point, Riverstone International, Enster Group, and Specialty Insurance, Blenheim, as well as SA Eacop, all these companies ruled out insuring the transboundary project. Riverstone International, in a statement, they said that they will not underwrite the Eacop project directly or indirectly, nor does it intend to. Sirius Point said it was not participating in Eacop, while Enster, Blenheim, and SA Eacop offered equally clear statement. These decisions come 4 months of targeted efforts by environmental organizations, including Coal Action Network, Insure Our Future, and Stop Eacop. So these activists have been urging the insurance companies not to invest or to insure this project, saying that they will be held accountable for the involvement in their dirty energy projects, which, as the activists say, endangers local communities as well as pollute the vital ecosystems. What's the impact of the refusal to insure Eacop? There are several impacts. One of them is legal and regulatory challenges. Insurance coverage is often a requirement for a large-scale project like this, and this is the project is supposed to comply with the legal and regulatory obligations. So the refusal of major insurance companies to provide coverage may present legal and regulatory challenges for the project developers, potentially delaying and hindering the project progress. It's also the financial hurdle, where there's a possibility of increased cost with this refusal to participate, and this will force Eacop to rely on smaller and riskier insurance company, potentially leading to higher insurance premium. There's also the impact of securing remaining coverage, where local insurers can only manage to cover 30%, leaving a significant funding gap. The government of Uganda might need to consider concessions or lower the standards to attract alternative insurance, and this raises concern about transparency and potential risks. There are also possibility of construction disruptions, lack of insurance coverage, could impede construction progress, as permits and approvals often require specific insurance guarantees. This could further delay the already delayed project. There could be also investor hesitation, where uncertainty surrounding insurance and potential financial risks might deter investors, making it hard for Eacop to secure the necessary funding to complete construction. There may be heightened scrutiny, where the insurance companies withdraw partly due to environmental and social risk concerns could attract further criticism and activism against the project. This could lead to stricter regulations and legal challenges, posing additional hurdles. Impact on the community, where without proper insurance coverage, communities affected by the pipeline might have limited recourse in case of accidents or oil spills, and this raises concerns about the accountability and compensation. Despite the statements of lack of intent to insure Eacop by the 28 insurers, there are companies that are willing to, or may be willing to, insure the project. Some companies such as AIG, Tokyo Marine, Chosa, Hiscox have been named as some of the companies that may be willing to insure the project. So despite the significant withdrawal of the major companies, there are some companies who have said that have not explicitly ruled out involvement. However, it is important to consider that they have not made it outrightly clear that they will support or they will insure. While this company has not outrightly rejected Eacop, their public silence could indicate concerns about the project risks and potential reputation damage. The withdrawal of numerous major players creates a challenging environment for them to step in. Even if these companies choose to participate, they will face intense scrutiny from environmental groups, activists, as well as investors concerned about the project environmental and social impacts. This could lead to legal challenges, protests, as well as reputational damages. If at all they engage, they are likely to face pressure to offer insurance with stricter terms and conditions, potentially pushing up cost and limiting coverage for the project developers. Even if these companies consider involvement, securing comprehensive insurance coverage at commercial viable rates remains a significant hurdle. The combined withdrawal of numerous major players raises concern about the project overall financial viability. Then there is a shift in global landscape, where there is increasing focus on sustainable development and climate change mitigation. These companies might face significant pressure from shareholders as well as stakeholders to avoid high-risk fossil fuel projects like Eacop in the long run. It is crucial to remember that while some companies have not officially ruled out the Eacop project, their reticence and the broader insurance industry trends signal significant challenges. Engaging with Eacop could carry substantial reputation, financial as well as legal risks for these companies, and even their involvement might not guarantee comprehensive or affordable insurance coverage for the project. The statement by the insurers follows similar sentiments that have been expressed by funding institutions, mostly the Western banks. These institutions have recoiled from the project. However, the Chinese lenders, Sinosure among others, are promising $3.5 billion for this project. But they are not yet to make. They have not made the final decisions, and this is something that is delaying the project. On the viability of the project, apart from the environmental concerns, the economic viability of the project has been questioned in some quarters. There are those who are arguing that the project is reliant on international oil prices, which are volatile. With the current global shift towards renewable energy sources, there is a real risk that the demand for the crude oil could decline in the coming years, making the Eacop project economically unfeasible. Explaining why the project is not attracting international financiers, some are arguing that Ugandan oil projects are failing to attract international financial or financing because these financial institutions know that the projects are not economically viable. now that the world is moving away from the fossil fuels to greener energy. Then there is a transition to from the fossil fuel that we have talked about. At the recent COP28 in Dubai, nations acknowledged the necessity of transitioning from fossil fuels and the importance of financial institutions investing in cleaner energy solutions. For the first time ever, over or close to 200 nations agreed to transition away from fossil fuels in energy system. This historical language marks a shift from previous negotiations, which focused on phasing down or reducing dependence on fossil fuels. While the text lacks strong enforcement mechanism, it urges countries to accelerate their shift towards cleaner energy this decade, aiming for net zero greenhouse gas emission by 2050. COP28 highlighted the urgent need for increased financial support for clean energy solutions in the developing countries. Calls for developed nations to fully and urgently meet the target of $100 billion per year in climate finance until 2025 were reiterated in this conference. However, despite the agreement in Dubai COP28, several key challenges remain. The COP28 agreement lacks concrete timelines and enforceability mechanism, raising concerns about its effectiveness in driving real change. Powerful oil-producing nations still hold significant influence, and achieving a complete phase-out might require further negotiations and compromises. Meeting the ambitions clean energy investment target requires significant financial resources, and mobilizing the necessary funds from both public and private sources remain a significant challenge. While the global push for cleaner energy and the COP28 agreement creates numerous challenges for Uganda's Eacop project, there are limited and tentative situations where it might be seen as favorable. The COP28 agreement lacks concrete timelines and enforcement mechanism, and this creates ambiguity, potentially allowing Uganda to argue for special consideration based on their specific economic situation. However, relying on such loopholes is risky and could be challenged by international community. Uganda heavily relies on the project for economic development and revenue for the government. If oil prices remain high in the short term, Eacop could generate significant income for Uganda government, potentially outweighing concern from some stakeholders. However, this benefit would not be sustainable in the long run as the world transitions to cleaner energy. As mentioned earlier, powerful oil-producing nations still hold influence, and the global energy transition might not happen as rapidly as envisioned. If Uganda strategically engages in future negotiations and compromises, there is a small chance for the project to be grandfathered in under specific conditions, but this is highly uncertain and depends on future development. Uganda could also consider repositioning the project Eacop as a natural gas project, where it might reframe Eacop as a transporting natural gas infrastructure, which is seen as transitional fuel with lower emissions than coal and other fossil fuels. However, this argument faces criticism due to methane emissions associated with natural gas and its contribution to climate change. Additionally, the infrastructure primarily targets crude oil transportation, making it significantly unlikely to shift. Building on that momentum, the environmentalists aver that the insurance and banking industries must take responsibility to avoid involvement in fossil fuel projects and help steer the world towards a safer and healthy and just future. Is the project struggling based on these challenges that is facing, the financial challenges as well as the insurance problems that have cropped up? The Uganda national oil company is defending the project status, saying that it's not struggling because it has already started. In November last year, 2023, Eacop commenced above ground installations in both Tanzania and Uganda, with a target of completing the project by 2025 December. The refusal of the major insurers to provide coverage for the Eacop project presents significant challenge and risk for its development and viability. The withdrawal of 28 insurance companies, including notable names like Sirius Point, Riverstone International, Enster Group, Blenheim, and SA Eacop, reflects growing concern from climate activists regarding the project's environment and human rights implications. This decision by insurance could lead to legal and regulatory hurdles, increased financial burdens, construction disruptions, investor hesitation, heightened scrutiny, and limited vehicles for affected communities. Additionally, reluctance of Western Bank to fund the project further complicates its financial sustainability. Despite these challenges, there remains some insurers who are still willing, although they have not explicitly ruled out their involvement in the project. However, their hesitation suggests that they are carefully evaluating the risks and potential impacts associated with insuring this project. Their eventual decision will likely be influenced by ongoing scrutiny from stakeholders and shifting global trends towards clean energy and sustainable development. While Eacop projects continue to face obstacles and uncertainties, the determination of the Ugandan government and its partner to proceed clearly shows the complex interplay between economic interest and environmental concern, as well as global energy transition. However, it is essential to recognize that the project viability and the long-term success hinges not only on insurance coverage but also on its alignment with sustainable development goals as well as evolving energy landscape. Thank you for reaching this far. If it's your first time here, please consider subscribing to this channel. Also, watch other videos that you have done on this channel. Leave your comment and share. Thank you.